today is going to be a different day. I know I've said that before, but today is really going to be different. So I'm pretty excited about that. I'm kind of calling it a resources day. So we're going to kind of show you guys some of the resources. Yeah, I'll throw some charts at you, I promise. All of our regular suspects. So we'll get that. We'll cover all that. But then we're going to kind of dive a little bit deeper into kind of what data do we use beyond the regular reports, and kind of beyond just plain old, matrix tools, although we will talk about a few. So we're going to kind of dive into some HUD data, some census data. I hope you guys are excited, and I hope you brought your stats lover hat with you. You should always be wearing that to these webinars, right? No question. First and foremost, well, maybe not foremost, but first, I always like to do a few shout outs to folks I see on. So I want to shout out Alyssa, former SPAR staffer extraordinaire. I want to shout out to Bill Sweat, all around good and funny guy. The KW Lake Minnetonka office. How many of you are there on today? Can you guys respond in chat? I don't know if it's 1, 2, or 20 of you, but I am curious. And then finally, Sarah Nurnberger, a persistent stats lover and constant learner. Welcome back. She's made almost all of these and just really grateful. There's Sarah. There she is. All right, folks, let's get going. This is going to be incredibly exciting. I say that every time, but I really do mean it. All right, let's get my share going. Homer's Group, one of us, KW Lake. Okay, just one? Okay, you see like a big office and you think there could be 50 people there, All right, anyway, be that as it may. Let's get our share going, you guys, and start to look at some market data. Okay, more than one. Awesome. All right, that's good. So here we go, guys. Market update, here we are, November. Year is 2022 for at least another month and a half or so, not even really. Kind of crazy how close turkey time and the year-end holidays are. They've really sped around the corner. All right. Former Goldman Sachs CEO. We lived through the Cuban Missile Crisis. We stopped Soviet ships in international waters. In the 60s, there were assassinations of public figures, kids blowing up draft centers, and the National Guard was shooting on campuses. We got through all that. We'll somehow get through this, you guys. This too shall pass, even if it doesn't feel like it will. So always some good perspective there. All right, speaking of good perspective and a little bit of a historical perspective and not just, well, interest rates have been below 4% for the last couple of years, so they're just going to always be below 4%, right? 2 years, not really a lot of history, not a ton of trend there. So take a look at this, you guys. This is from the KCM folks, Keeping Current Matters. I really do like those guys. Good content, good charts, good little infographics to use on social, mailers, or at some of your opens. But just know that it's not local Twin Cities North Star data. So it's good, it's educational, it can help your buyers, and it can help manage your buyer and seller's expectations and all that. But it is not, perfect. It's not our local perfect data, the way the North Star data really is the absolute gold standard. So, just take a look at this, guys. Let me get my pointer going. Okay. So take a look, even though supply grows, right? Supply is up. We're still pretty deep in a seller's market, right? As evidenced by, less than 5 or less than 6 months of supply, with 5 to 6 months still being that balanced point. Some expand that to 4 to 6 or even 4 to 7 is relatively well balanced. But really that 5 to 6 mark is kind of historically a balanced market. So guys, check it out. We can see kind of flattening out a little bit, and then COVID, and then we really lost all of our supply, and sellers and builders weren't able to replenish it. So, look at where we're at today. Yes, we are up, but we are still so far below a neutral or balanced market, right? Think of this as market equilibrium, where the market is kind of balanced in the middle. It's not leaning toward, sellers, but it's not leaning toward buyers either. And you guys can see, people are making a big deal out of it. And in some ways, I think that's valid and justified, but in other ways, it looks like a decent change, and it is. I think absorption rates are up, what was it, 30%. So, it is notable, but guys, we're still so deep in a seller's market, but it is changing a little bit. And so I thought this was kind of a useful way of saying, no, we are not here. We are nowhere near here. We're not even that close to here, right? We're not even really close to this 6-month mark. And by the way, like I said, this is national, not local. All right, guys, you seem to like this stuff, looking at showing. So we'll show some of the trends that the showings data are showing us. No, I don't like to do that, but let's take a look at what the showing data can tell us. Last 4 years, this year, all the way back to 2019 in gray. All right, I like to point out, here's your COVID signature as usual, right? There's 4th of July, Labor Day, looks like turkey time here, and then year-end holidays here. You guys can see, right? It was just about the moment the Fed started to change rates dramatically. That's when we saw our showing activity start to come down. Specifically, it's when we saw this year's showings start to diverge, right? We've got divergence and convergence started to really diverge from, the last few years, specifically the last normal year or typical year, which was 2019. So you guys can see we were kind of on track, on pace with those levels before we saw this divergence. And we know what caused that, right? Changing mortgage rates. I should even say doubling mortgage rates from 3.5% to now 7%, right? Just about a doubling. All right, as we know, right, showing activity is not a monolith, right? It's not monolithic. It's not good enough to say showings were up X% or down Y%. It's just not good enough. What does help us sort of peel back the layers of the onion a little bit, don't cry, is, to look at this in terms of price points, to look at showing activity broken out by price point, both for the most recent period and the same period a year ago. So that same year ago period. All right, so the way to read this is last year, 19.3% of all showings, last year at this time, 19.3% of all showings occurred on listings under 200K. For the most recent week this year, it's about 18.7, so a little bit less, but not that much less. What's interesting over here? Let's see. Let's shift over to here, 600 to 800,000, 4.5% up to about 5.8%. So kind of a big change there. And you guys can definitely see the shift, kind of going away from 200 to 250, even 250 to 3, and starting to move into the 3 to 4, 4 to 5 ranges, all the way up to luxury activity at or above $1 million. Not a huge gain here, right? 1.9 to 2.06. So not a huge gain. All right, guys, let's look at some of our usual suspects, as I say. So looking at just sort of seller activity, buyer activity, prices, market times, inventory, or one of my favorites, the ratio of sold to list price, and of course, month supply, one of my other favorites. I love all of our indicators equally. It's just that sometimes, you love them all equally, but sometimes you can like one more than the other. Sort of like family, right? We love them all, but sometimes, depending on the day, we can like them a little bit, or maybe it's their behavior. We like their behavior. Anyway, pull up, David, pull up. October new listings, you guys, you can kind of see, right? Look at when we had all that supply coming on in the 04, 05, 06 period. After the crash and the mortgage and foreclosure crisis, right? Supply levels came way down. Sort of been bouncing around here, nothing too exciting. And we really have definitely not gotten back to those levels. Although look at that new listing activity coming on, right? All those listings coming on as folks were moving up, right? So they wanted more space. They wanted the extra bedroom. They wanted a place to entertain and be at home. And so, you saw those folks kind of trading up. And then heading into this year, we saw sellers were down about 20%, right? So down just about 20%. I think we are kind of comparing to these elevated levels. You think of that as an elevated baseline. It's not really apples to apples just because of what was happening over the last few years. So maybe it is useful to compare to more normal years. Again, we're going to be kind of playing this game, you guys. The year over year is factual. That's what happened. But really, that's apples to oranges. So to have apples to apples, you have to kind of go back to a more normal year, keeping in mind we've had population growth and a lot of new household formation since then. All right, how about annualized? Let's look at this on an annualized basis, guys. God, we almost cracked 100,000 new listings, just barely, just below that 100,000 in 2006. So far this year, we've got 62,000. That is down more like 9.5% compared to 20% on the monthly for October, but only about 9.5% on an annualized or year to date. I should really be saying on a year to date basis. My mouse doesn't seem to want to cooperate. Anyway. All right, so how about pendings, you guys? Shifting over, that was the incoming supply side. How about the outflowing demand side, right? So I always like to compare it to a bathtub, kind of weird. You got the spigot with new listings coming on the market. Then you've got the drain with that inventory flowing out of the market. And so inventory really is a moving target because it's the water level, right? It's the water level in the tub, but that water level moves so much as water is flowing out of the spigot and sales are flowing down the drain, right? Down the drain seems more negative than it should be, as sales flow out of the tub, out of the pool. Maybe I should be framing it that way. All right, guys, so just kind of another way to think about it. October pendings, right, down 37%. I will go on the record and say that is a significant change, right? That is a significant change. However, here, you guys, you can really see it. You can really see how we're comparing to this elevated level. So it's not really an apples to apples change. I think this is probably more like an apples to apples change just because of what was happening here, right? So if we do compare to that more normal year, all right, we're down more like 20% versus almost 40%. Guys, I'm not putting on the rose-colored glasses, I promise. This is the fact, 37.3%. That is factual. That's the fact. That's the percent change from last year. But is it a good methodology, right? That's the mathematics. The math is that. But is the method right? Is that the right method to compare to just last year, or worse yet, to compare to October of 2020, right, when we really had this sort of pie in the sky kind of market? So this is the fact. This is probably a little bit more like the reality. How about when we annualize this and look at this on a year-to-date basis, right? So kind of the bubble heading down into the crash. Look at the tax credit year. Remember 2009, that tax credit year? A little bit of a recovery there. Always find that interesting. And then you guys can see we kind of flattened out a little bit. I think that's inventory driven, right? In large part, I think inventory kind of capped some of that sales activity. And then, buyers blew the cap off and they just said, I don't care. I need to buy this house. And so we saw them making concessions, skipping, paying $40K over, skipping inspections, escalation clauses. Who needs inspections? I love black mold. Smells nice. Anyway, so guys, pending sales on an annualized basis, down more like 18.5%. So again, sort of three measures. Kind of three measures, guys. So year over year, October, that's what that looks like. How about compared to a more normal year? That's what that looks like. And then what if we sort of annualize our data or our time frame? And that's kind of what that looks like. So different lenses, guys, different ways to look at demand, right? That was pendings, that was signed contracts. How about actual closings? Here's another way to look at demand, right? Down 33, down a third. But again, you can really see this pie in the sky type of phenomenon. Otherwise, I mean, for October, you can see pretty steady eddy growth. So another kind of thought here, you guys, look at this chunk. What if you reallocated this chunk over here, right? It probably should have happened over here. Instead, 2022 demand was sort of pulled into 2020 and 2021. Now that demand has been squashed in part because of rates, but a lot of that demand that would have happened this year was kind of sucked into the last 2 years because of very friendly rates, because of needing, more space and more work from home sort of arrangements, during the pandemic. If we sort of annualize or look at year to date, okay, down more like 15%. But if here again, folks, if we compare to a more normal year, right, of 50 or 51,000, we're only down, what is that, 6%, 7%-ish, something like that. So you got to take this stuff with a grain of salt, you guys. Yes, it's factual, but is it really a fair comparison? Is it a reasonable comparison? So I want us to be thinking about that. Oh, there you go. I did the math because I was worried about doing the math, but I'm a researcher. I can do math, but every now and then it's good to have a little security blanket in your pocket. All right, guys, October close sales for October of every year. Well, I suppose we denoted it here with 10-2003 and 10-04. So this is October of every year going back to 03. Obviously, our data only goes through last month, through October of this year. And that's last month right here, right? That was October of 21, and that was October of 2020. Now, this is homeostasis. This is equilibrium. This is where the rubber band wants to be. When I pull the rubber band this way and I let it go, does it snap back to equilibrium? No, it overshoots, right? Always, it overshoots before it kind of gets back to normal. A pendulum, if I move it over here, does it stop? Sorry. Does it stop right in the middle? No, it doesn't stop right in the middle, right? It always overswings kind of before it sort of stabilizes. So this is what we see happening, right? We were way above and now we're kind of way below. And I think in the coming years, we'll kind of get back to trend, right? I have a chart. I think I'll actually show it. I've got our great mean reversion going back to 1960, right? You're above, you're below, you're above, you're below, but that's what makes it a mean, right? Is kind of in the middle. It has gravity. It wants to pull things back, right? So look at our sales activity, assuming average growth. This is linear, you guys. This is linear, assuming just regular, steady eddy, 2 or 3% growth. That's where we'd be. But we were way above that. And now we're way below that, right? Because that's what happens to the rubber band when you pull it. It snaps back and overshoots, and we've overshot. Now, I think it wouldn't be this dramatic if we didn't have rates doubling on us as they have. So, maybe we would have snapped back to more like here, or more like here. So, rates are definitely a factor here. So keep that in mind. But guys, not an official forecast. Don't hold our feet to the fire on this. But this is just one view, one scenario of what demand could look like in the market moving forward. So here we are, kind of coming back a little bit, maybe flattening out. And here again, you guys, it's possible we overshoot a little bit because of the pendulum effect. It's possible. And then maybe, who knows? Is there another recession? I don't know, guys. Nobody does. So it's not like we'll just get perfectly back on track, in a linear way. But, I think we'll kind of be bobbing up and down, but we'll more or less be back on track. I don't know if that's 1 year, 2 years, 3 or 5, probably longer than a week and probably less than a decade. I guess I'll say that. Oh, we were chatting about this the other day. Did you guys know New York? I think New York passed a law on salary disclosure. So I think job listings have to disclose like the minimum and maximum compensation. And so they were testing it out. And who was it? I don't know if it was Goldman or Morgan Stanley or Merrill Lynch or someone, put their range on, and their range was, from, 38,000 up to 18 million. That was their range because their top guys paid 18 million and some of their entry level or, I don't know, more janitorial staff or something might be, on the lower end. So, well, that's useful, somewhere between 40,000 and 18 million. That really narrows it down. So that's what I did for you guys. All right, guys, October median CDOM, cumulative days on market. How are we looking in terms of market times? 22 days, up over 50%. right? So we went from 2 weeks to just about 3 weeks, right? That's been the movement. So 2 weeks up to just about 3 weeks, still below, right, 2019 levels. Put another way, homes are still selling more quickly than they were in October of 2019, right? I think that's an interesting data point. But yes, it's true. Homes are not selling quite as quickly as they were, sort of during the panic frenzy buying of the when we were in the throes of the COVID pandemic. Far cry from 100, right? 90 or 100 days on market, right? So 14 up to 22, and obviously monitoring this one closely. So let's see what happens. Let's see what happens in terms of market times. Let's annualize this, you guys, as we've been doing. You'll notice a theme here. And there's a reason for the theme, right? We've got October data now. We've got 10/12 of the year. That's 5/6 of the year. Oh boy, what's that on a percentage basis? It's got to be over 80. What is that, 85% or something? 85, 87% of the year. So, right, we've got the vast majority of the year in the book. So it's worth looking at year-to-date data, right? And so that's what we're doing. So far this year, right, that was October. That was just October. For this year so far, homes are spending 2 more days on the market, right, which is 20%. So from 10 to 12, 2 more days, still well below 2020 levels, even though the monthly data doesn't show that, right? The monthly data doesn't show that we're still below 2020. But for the year as a whole, so far, I should say, right, still below 2020 levels. All right, price, dollars. Let's talk about the money. Here we are, guys, 355.5. So down from the May and June peaks of this year, which were what, I think about 375. Did we touch 380? We might have almost touched 380, but I know just about 375. So here we are, up only about 4.5% from last October. Now, that's compared to an 8% gain and a 12.5% gain over the prior few Octobers, right? Over the last couple years. So while price growth is still positive, the rate of growth has slowed, right? From 8 to 12% down to, call it 4 to 5, 4 to 6%. I want to repeat that. Price is still rising. Price growth still positive, but less so than it was over the last few years. Our foot is off the gas a little bit, right? So we're still coasting and moving forward. We're not on the brakes, and we have not thrown it in reverse, right? We're off the gas and kind of coasting from 70 miles an hour down to more like 60, 65. So you guys kind of see that here. How about on an annualized basis? Again, stick with our theme here. So far this year, prices only up more like 7.5% versus 11.5% last year, and the year prior 9%. So once again, folks, price growth still positive, but at a decelerated pace. Price is still rising, but to a lesser degree at a slower pace than they have been. Don't believe me? You should. But let me prove it, right? Show, don't tell. Let's show, not tell. So year-over-year change in median sales price, all the way back to January of 2004. Here's some of the growth in the bubble. Here's when we shed 25% of our prices in the crash. Here's a little bit of temporary recovery in the tax credit period. Here's where we had to find our real bottom. Here's where you saw a lot of investors and flippers descending on the market and paying cash, right? Here's where you saw more of a normal sort of market recovery, right? With average sales growth. Here's a pandemic period, right? Guys, it's pretty clear to kind of see these cycles and these impacts and sort of what's happening in our world. We can really see that in the data. So sure enough, timing checks out, right? Just about mid 2020, you start to see price growth. You really start to see this heightened price growth. Over 10%, right? For a long time, we were kind of at or above 10%, hitting 16.5 even. You guys can see though, right? Look at 2022, just as we've gotten, just the beginning of this year, I suppose we had 1 month of almost 10, but we've really started to slow down. the rate of price growth has really started to slow down. And sometimes we kind of zoom in a little bit. So you guys can see, right? 12, 16, here's our 10% mark. And we've really come down to that 4 or 5% year over year price growth. Guys, I'll also go on the record and say that's a good thing. Okay, that's a good thing. Prices rising at 10, 15, 16%. It's simply not sustainable, right? It is that simple. Housing will become way too unaffordable for far too many. And that's not good for our city, our country, your business, or your personal finances, right? So, you know, that is not a sustainable thing. Sellers were loving it, right? Sellers were loving it, unless you then have to also be a buyer, which is about 95% of sellers, except those, you know, moving into institutional care or, you know, I guess moving out of state or what have you. So price growth still positive, but slower. Guys, sometimes we get this question, what's the difference between median and average? I haven't shown this one for a while, so let me take it out. All right, we've got a joke about this, so you guys are in luck. Jeff Bezos walks into a bar. On average, everybody just became a billionaire. But the median income really only moved from 70,000 a year to 80,000 a year, right? Let's take a look. Here's the 6 patrons at the bar, one making 40, 150, 155, all the way up to 125. And in walks Jeffrey with 200 million in income. Okay, what's the average income for these folks? Average income is $28.6 million for this group. What's the median income for this group? $65,000. Why? The median is the midpoint where half the folks earned more, half the folks earned less. Your average, right? It sums them all together. It adds them all together and then divides out by the 7 people. And look at how high that is, right? Do you think this is representative of this sampling? I would bet you're shaking your head no. I would hope you're shaking your head no. Because if you're shaking your head yes, I think you're wrong. So guys, let's multiply this by 10 instead of, well, this is probably more accurate, instead of 200 million, right? Here's 200 billion. So look at what the average did. The average went from 28 million to 28 billion. But what did our median do? Didn't move a penny, didn't have to. Still had 3 people making more and 3 people making less. Our median didn't move an inch, didn't have to. Guys, this is why we believe the median is a better measure, right? We call it a measure of central tendency. What's the central tendency of the data? What's your typical price of the homes? Here's 6 homes, right? I did this maybe a year or 2 ago where these prices were maybe a little bit more realistic, hard to find some 150s and 225s, even 275s nowadays, but let's just play the game with me and just look at these 6 listings. Average sales price, $833K. Median sales price, $312,500. Split the difference between the middle 2, right? So you're telling me that we only had 1 of 5 or 20% of listings above this average, right? There's only 1 above that average. But the median has still 50% below and 50% above. I hope that's enough to convince you guys to think more about median than average. But the reality is, I know you guys will use whatever helps you prove your point to your sellers. I'm only kind of kidding, only sort of kidding, mostly kidding. Anyway. All right, guys, October percent of original list price received at the time of sale. What are sellers getting? What are they accepting? Just about 98.25, right? Sure enough, pretty consistent with 2019 levels. In fact, up a hair, right? Up a 1/10% here from 2019 levels, from 98.1 to 98.2. But the change looks pretty dramatic and pretty scary when you consider we were over 100% for the last 2 Octobers, right? Sellers yielding 100.5% of their original list price in 2020, sellers accepting 101/3%, 100.3% of their original list price that they received at the closing table. Guys, 98.2 is a good number. It's a strong number. I mean, look at the bubble, right? And look at the meltdown. Look at the Great Recession, right? So we can't we can't hold on to these with diamond hands and say that this is the new normal, because it's not. So this minus 2%, again, looks pretty dramatic. We're used to plus 0.2, plus 0.3, I guess 0.8, minus 0.5. So, this 2% looks pretty dramatic, minus kind of coming out of the recession here. But the reality is we had to come down. There was no choice. We cannot sustain this forever. How about on an annualized basis? Interesting, really interesting here. So for the year so far, not just October, but for 2022 so far, sellers are getting 101.5%. I know that is skewed by March, April, and May numbers when rates were only, 5.5%. Now that they're 6 3/4, 7. I understand it's a different ball game, but still, you guys, it makes sense to kind of look at the year as a whole, especially that we're 5/6 through it, 5/6 of the way through it. October inventory level, inventory, homes for sale, housing supply, active listings, all of these are synonymous, not synonyms, synonymous. So take a look, guys. So we did see a little 6.5% jump in inventory from 8350 to about 8850. So not a huge jump, especially considering the fact that we had almost 35,000 active listings in our marketplace, kind of in 07, kind of 06, 07, 08, over 30,000, right? And people want to celebrate going from 8,300 to 8,800. While it is a gain, guys, it's still even below 2020 levels after we had a 26% decline in the number of listings for sale, right? You can kind of see us stabilizing a little bit at, between 12 and 13,000, kind of flattening out a bit between 12 and, I guess, 12 and 12.6 or so. And then we came way down in COVID when everybody was buying homes, but we didn't have as many sellers or builders sort of listing them. So there wasn't that replacement rate, you guys, right? The spigot was not putting the water in the tub to replace the water molecules that were flowing out of the tub. I bet you didn't sign on this Zoom today thinking you were going to hear a lot about bathtubs, but there you go, guys. Bathtubs it is. So 6.5%. I think the moral of the story here is careful what your buyers are taking away from this. My fear is that they're going to look at this. Oh, wow, I got 6.5% more active listings. I can now go around and start lowballing sellers like it's 2008. I mean, you may be able to write offers at 98 or 99% of list price instead of 102 or 103%, but you're probably not going to get away with 90%. Or probably even 95, all that often, like we saw sort of in this period. But yeah, I think you might get away with this. I think 98, 99, is okay nowadays, instead of coming in at 101, 102, even 103 or 4. Folks are writing offers just about at list price, maybe slightly below, or maybe at list price with some seller paid closings or some concessions or some fixes from the inspection or what have you, guys. So just be careful. Yes, there's a little bit of an increase in supply. Sure, I suppose that can be celebrated cautiously, right? Cautious celebration, cautious optimism. I like that. Every celebration is cautious nowadays. So, a little bit of an increase, not much of an increase, and we are still drastically undersupplied. Again, as demonstrated by our month supply of inventory figure, again, while up 28%, still is below 2 months of supply, right? So we're still not even at 2 months of supply. So really still have a tight market. The balance of the market is still tight. It is still favoring sellers, although less so than during the last 2 Octobers, okay? So about 2 months of supply, higher than the last 2 years, but still tighter than 2019. So still, a stronger seller's market than 2019. And, still a far cry from 7, 8, 9, 10 months of supply, sort of in the old days, right? Oh, someone did a little chat. Hey, Mark's on the call. Hey, Mark, the data is history and important. What does it suggest what the next 6 oaths or months, the next 6 months may hold? I think that's so rate dependent, Mark. It's a good question. Mark always has good questions. And he's really tuned into the market stuff, and he's really tuned into the political environment too. So thanks, Mark, for your work and your brain on this stuff. I think it's so rate dependent and, recession dependent. Yes, no. I will say, looking at this, we've got a lot of room to go, even if inventory increases somewhat significantly and sales kind of stay down where they are. I think it's going to take a lot of work to get us back to 4 or 5, surely 6 months of supply. So, I think the market will remain tight. Maybe we get to 2.5 or 3 months of supply, hard to say, and that will mean things are a little bit looser for buyers. And that's a good thing, because buyers have been frustrated and flustered by writing 10 offers and still not having the keys to any house. So, this rebalancing, I think, is a good thing. But again, you guys, the worry always is that pendulum. So we're a little hot. We want to get back to normal, right? But we don't want to overswing so much. So, look, we got right from a balanced market up into a buyer's market. And then we went from this buyer's market, bam, right down into a seller's market. So there you have, again, that sort of pendulum effect. And Mark and I have talked about this pendulum effect. Mark and I have been nerding out on the market for 10 years. And I always love hearing his opinion and experience. So Mark, keep the questions and thoughts coming. But yeah, that's, kind of one way I see things moving forward. Let's see, guys, quick check here. Linda, listen, internet went down. No problem. This class is not for CE. This is not CE, so you are totally fine. No problem here whatsoever. All right, guys, just kind of throwing this out. I know you've seen it. We won't spend a ton of time on it. Sellers markets. You've only got one house, but you've got all these buyers competing for it. They're going to outbid one another, right? Someone's going to be in cash 5% over. Buyers markets. Now you've got 3 sellers, but they're kind of competing with each other to lure in the buyer. So these buyers have to outbid each other and write offers that lure in the seller. Here, these sellers have to reduce price, offer rate buy downs, fix the house based on the inspection to lure in these 2 buyers, right? So really a very different marketscape, if you will, or landscape, if you will, versus a balanced market where you've got supply and demand both pretty well synced up, sort of well in tune and well synced up. All right, got a new one for you guys. God, I got to keep trucking. I've got a lot of stuff I want to show you, and I don't think I'm going to have time for all of it. All right, let's use a few assumptions. 7% rate, 10% down, 1.2% taxes, and 0.5% insurance. So those are our assumptions. And look, guys, look at your PITI payment. Before you get too excited, I want you to know I'm using 2019 prices. And so don't get too excited yet. I have to update this with the latest data, and we will. But I just want you guys to kind of see, here's some of our peer cities, and here's sort of some other areas, but these are sort of our official peer cities. And that comes from Greater MSP. Speaks to, population, growth, the economy, a little bit of weather, I guess, minus San Francisco and Dallas, Fort Worth, and I suppose Austin and Atlanta. But, not fair to compare us to Honolulu and Miami, all day long, or, that doesn't seem reasonable. So you guys can kind of see, right? Look where payments are. Look at the PTI ratio, price to income ratio, right? So where are we spending? So we're actually about 3 instead of 2.7. We're more like 3 times incomes on housing. San Francisco, more like 7 or even 8. Who's here? Los Angeles, our friends in LA, spending 9 times incomes on housing. That was a few years ago. They're probably spending more like 10 now, if not more. So what, out of 25 regions, we are 16th in terms of, where our payments are. I think that's interesting, guys, to compare us to other regions. I won't spend 20 minutes on this, but I think it's pretty fascinating. Here's our friends in LA. You know, how would you like the median payment, or sorry, the typical payment on the median priced home to be $5,200 a month? Wow. I mean, we hear folks complaining about going from 1,800 to 2,200. I mean, can you even imagine? And guys, look at their incomes. Okay, so here we are, 105. LA actually has a lower income. Now, that's everybody. That's the median family income. Here's what NAR reports as the buyer's income. So forget those. Here's the ones that are actually buying the house. So in LA, you're more like 130, right? Versus your typical, you know, sort of at 80. Here, our median family income is about 105. And sure enough, people, a household earning 105 is buying, you know, is that typical family that's buying that house. So again, pretty fascinating here, guys. We love data over here. Just a good way of kind of contextualizing or putting us in context with some of these other regions. All right, guys, resource day. We've got to shift gears. We've got a lot to cover. Guys, there's no way I'll make it through all of it, and that's okay. All right, so give you guys a little bit of a rundown here. So sort of our local info here, you know, statewide, we've got permits, NAR rates, incomes. We're even going to play with some census data. So let's get going, you guys. Right here, this is the big one. That's why it's at the top. It's the market data section of our website. We've got tons of great links here, even getting you into InfoSparks and Matrix, which we'll talk about. FastStats portal that holds all of our weekly, monthly, annual reports. You've got our webinars that you're on right now. You can do the skinny video, you know, and everything's kind of right here. So highly encourage you guys to bookmark that. All right, so, you know, obviously North Star has a lot of other good resources. And, you know, we're just covering some of the basics here. Some of this does get a little, you know, a little deeper and a little geeky, but know that, you know, these are some of the tools and resources that we rely on to kind of do what we do. And, you know, we've heard from you guys, you know, well, where do you find that? How do I get that? You know, where are these tools and resources? I would bet anyone on the call here, you know, is familiar with InfoSparks and how to get there. Just in case you're not, right? One click, you can look at median sales price, right? There it is. Oops, let me check on something. Okay, yeah, we did hit 380, guys. I was wondering if we hit 379.5 or 380. We did touch 380, right? There you have it. I can look at closings, market times. There's our 22 days on market. I can look at percent of original list price, right? There's our 98.2%. So sure enough, guys, it's the same data because it comes from North Star. So yeah, that's just kind of our FastStats link. I won't do that one. Sortable stats. Let me do this one, guys. This is an interesting one. By the way, you can get there right from our homepage, click on market data, and you'll see sortable stats right here. So check this out. You're going to like this. Closed sales and the change, median price and the change, days on market and the 1 year change. Now, here's where the magic comes in, right? Sort. I've just sorted all these areas from high to low based on sales count, right? Well, I suppose I should be naming these, right? So MSAs, communities, right? Minneapolis communities, Minneapolis neighborhoods. Then we've got our St. Paul neighborhoods. And then we've got every city in the metro. No surprise, Minneapolis followed by St. Paul, followed by Maple Grove, and then your Blaines and Lakevilles and Brooklyn and some of your bigger cities, right? Okay, so we just sorted based on sales count. How about sales growth? Oh, interesting. Out of all Minneapolis communities, only Near North actually had an increase in sales activity. Pretty interesting. Well, check out the price point, right? A little bit more affordable. You know, the Phillips community in a similar boat, a little bit more on the affordability side, you know, a little bit skewing more toward the affordable listings. And so that's the only segment where we actually, or I should say the only community where we actually saw an increase, right? Hawthorne, Bottineau, right? Willard, Hay, these are neighborhoods within that wonderful North Side community. How about which cities have the biggest growth? Lakeland, Delwood, interesting. Corcoran, Elko. Ooh, so folks are looking down in Elko. Where are sales shrinking the most? So guys, we've got a lot of zeros here just because these areas just, Tonka Bay can only have so many, $5 million sales. So just be careful here, right? Minus 80%. Just be careful here. When you see something like 15 in Princeton, well, that's pretty decent data. Even the 6, 7, and 8, the 1s and 2s and 0s, just be careful with. Obviously, that's incomplete data. Did I just see where's Jackson Township? I wonder if Mr. Pino is looking at that community. All right, so that's sortable stats, guys. Some of you may not be aware of this. How about prices? Where are prices the highest? No surprise, Lake Minnetonka area, 8.25 versus Southwest Minneapolis at just about $500,000. Our central community, which is of course skewed by the Mill District and some of those condos happening over there. By the way, as the 11 tower sells and closes, that is going to be technically in the central community. Let's go to cities, just check them out real quick, guys. I could spend literally days on this. All right, so there's our friends in Deep Haven, 2.1 million, followed by Sunfish Lake, right? So we've got several, over 1 million, guys, all the way down to Orono. All right, you can do that with market times, month supply, and percent of original. We've got to keep moving. Oh God, 10 minutes. I won't spend too much time here, guys, on the statewide. Just know the state association does produce reports. I'll just give this one a click. Seller activity, buyer activity, price movement for the whole state. And then you've actually got the monthly indicators. So you've got this sort of similar dynamic, right, that we have, pendings, we've got the history. What's interesting in their world is they have all these different regions right across the states. You've got the beautiful Arrowhead region and the North Shore. Then you've got, some of the activity in Southeast, like Rochester and the DMC, Destination Medical Center. And then you've got some, college towns kind of around. And so, different regions around our beautiful, dynamic, and diverse state. So the Northwest region, Headwaters region, right, Arrowhead region, all corresponding to their map. So if you really want to zoom out, that is one option. All right, building permits, Housing First, our friends at Housing First, formerly BATSI, the Builders Association of the Twin Cities. All right, so Housing First, what does it want me to do? Visit their newsroom. What am I looking at here? Home builder activity, Minnesota home builder activity. There we go. October, building activity, past 12 months. So there's your permits. Top cities for building activity. I suppose, let me just pop open the PDF. Josh, speaking of the spigot, are builders still building? I mean, apparently a little bit, but it seems to mostly be skewing toward multifamily and apartments. At least for now, we're hoping they're building condo quality apartments that can be converted over to owner occupied product later when rates maybe normalize a little bit or incomes keep rising, or we somehow, are able to address, our supply challenges. So you guys can kind of see, how that looks. By the way, when we permit more units, it does not mean that they're of a higher value, right? You can have 5 units permitted in Wayzata. Each, 5 units is $1 million a door. That could be a $5 million permit. And you can permit 10 homes somewhere else at $300,000 a door, right? So you guys can kind of see, sometimes you just have to kind of be aware of that. All right, another place to get permits, let me just click on this one, is the St. Louis Fed, lovingly called Fred. So here you go, new private housing units authorized by building permits, 1-unit structures in the Twin Cities Metro. You might notice, friends, that there's a seasonality to this. Winter. Snow is a thing that happens here. So you guys can see, even as demand was well above 04, 05, 06 levels, right? Even when demand was well above, our building permits didn't even come close. They didn't even come close. 1,100 versus, 2,000. I mean, we have underbuilt for going on 2 decades, right? And we wonder, well, where did the supply crisis come from? Well, it came from right here. That's where it came from. That's where it came from. You guys can see, so Josh, to Josh's question a little bit. Yeah, I mean, you guys can see with what rates have done to demand, builders have slowed down, and we are starting to see that in the data. So that's just on permits, you guys, but not to go back too much, and I know clock's ticking, but you can also look at new construction, new listings. Let's see, new construction, new listings. Let's go. I always like looking at the larger time frame. So guys, they're actually still listing them, but are they dropping price? Well, this is just what's sold, of course, not what's listed. But you guys can kind of dive in and really play around with this. Looks like it's taken a second to load. So I'll let that be for now. Oh, maybe it was going. So know that you guys can play around with that. All right, NAR also has some good resources for us. Latest slide deck, guys. This is from Dr. Lawrence Yun, Chief Economist at the National Association of Realtors. You'll see this is his latest slide deck. And they're usually, really good and really helpful, right? So talks about recession, residential investment, kind of cutting into GDP growth. They've got their PHSI, their pending home sales index, and a lot of other, pretty good data. So, use them as a resource. Interest rates. All right, let's keep going, guys. We might make it through this first page. I think I spent too much time geeking out at the beginning. Guys, we're back to Fred. All you got to do is type in 30-year, boom, fixed rate mortgage, and you'll get the 30-year fixed rate mortgage. Remember how fun it was when the 30-year interest rate, when the 30-year mortgage rate was at 18.6%? Yay. Some of you might remember that. How about recently? There's your 2.75, guys, 2.67. Anyone who nailed bottom on that one, congratulations, bottom hunters there. Touch 7.1. I guess I'm a little bit encouraged that we've come down a little bit, but I was almost faked out here, you guys, right? Remember when we touched 5.8, we actually went back down and touched 4.99. And now that we crested over 7, it would be nice to kind of settle back into 6.5, maybe 6.25. Let's see what happens with some of the inflation data. Latest CPI data, the Consumer Price Index, was better than expectations, right? So looks to be subsiding a little bit, but not, obviously we're not out of the woods. MND, Mortgage News Daily. I like these guys. They've got more up to the minute, maybe up to the day data, while, sometimes, actually, I suppose this is really recent, but this is weekly, you guys. So look, the last observation is November 10th. So I like MND because it moves more quickly. And I also like that it has the 30, 15, and the jumbo sort of all in one. And they even do have a little bit of analysis. And I think they do it daily. So kudos to them. I think they do a really nice job. Incomes, HUD user, HUD data. What's going on here? HUD user, just got to find the data. Just got to go to the data, right? Query tool, fiscal year 2021, MFI documentation. Okay, guys, you see, I bookmark this. You can bookmark this. You can look at any metro. I know some of you do relocation activity, so that might be useful. I'll just click on Minneapolis, St. Paul. Let's view the calculation. Let me scroll all the way down and boom. There's our 2021 median family income estimate. You guys have seen that 104.9. That's where we get the data. Talking about incomes and earnings or wages, I guess, all different forms of earnings, I suppose. The Atlanta Fed has a really, really nice wage growth tracker. I really actually love it. I also love that they segment the data, right? They separate out different kind of segments. So wage growth, all right. Wow, in light of inflation, workers demanding a little bit more to make ends meet and to really just keep their purchasing power flat. So check out wage growth, guys, right? Up pretty considerably from kind of where it was. Now, college degree, interesting. How about male, female? Interesting. Has not historically been the case. That gender pay gap has historically been noticeable. So quite pleased to see that rate of growth kind of a little bit better synced up. You can look at hourly workers. Are you in your prime age, right? Are you staying, or are you a job switcher? Look, if you're job switching, wow, now you're 8.5%. But if you stay, job stayer, okay, only 5.9. So pretty interesting stuff there, guys. All right, census. This will probably have to be my last one today, and we will pick it up next time. All right, census data, guys. Here you are, data.census.gov. It looks scary. Don't be scared by it. Just click here and start typing. Minneapolis housing. All right, it's kind of all I had to do. Let's see. Tables. Oh, okay. Total housing units in Minneapolis City. All right, about 200,000 units. And that's with a population of what? Is it 380 or about, I think it's about 400,000. So just about 2 people per household, go figure. All right, so Minneapolis City, let's see some occupancy characteristics. Okay, how many occupied homes, how many vacant? How about, okay, so that was status. How about occupancy characteristics? Occupied housing units, occupants per room, family, married, right? Other, householder, non-family households, with kids, without. So there should be some, interesting. You guys will notice we've got occupied housing units. And then we've got owner occupied housing units. Huh. If I take this 90, call it 94,000 that are owner occupied and put that into this 188,000 that are total occupied, right? That's your home ownership rate, right? And it's just about 50%, for better or for worse, in the city. Now, let me just intuitively click on geography. I'll click on metropolitan area, right? I want to kind of compare this to, the metro as a whole. So I can throw in, it's going to take a second to load, but I can throw in the metro or the state, and then you can look at how the city or Plymouth or Bloomington or whatever compares to the city of Minneapolis, or compares to the metro, or compares to any other city. And it doesn't seem to like me. Here we go. There we go. Let's throw that guy in. There we go. Let's make this go away. There we go. Still a little slow. All right. So here we have Minneapolis, you guys. Now look, I've also got Minneapolis, St. Paul. And look at the difference, guys. Look at owner occupied. All right, about 1 million into total of 1.4, right? So what is that? More like 66, 70%, right? Higher than the city of Minneapolis. No surprise, right? More renters, more younger folks, more renters, in the city, obviously. All right, I see we're at 301, 302. I'll just call these out, you guys. I really, really like calculated risk. It's a great way to show not just, residential market activity, but kind of a broader, market or economy, or more of a macro, kind of a macroeconomic blog. So I really do like that. And then, of course, advisor perspectives, and look for the D short link. I'll just, might as well click it. Why not? And then you guys will see, right? So manufacturing, unemployment claims, housing starts, new housing permits, Philly Fed manufacturing index, right? So kind of see the contraction here, retail sales, HMI, housing market index, not looking so beautiful here. But these things can come back quickly, right? It's possible. So a lot of other good data there. I guess I'll just click on calculated risk. Thanks for sticking with me, you guys. And so they've got a lot of, again, really good data, active listings, housing starts. I love that he separates 2+ unit and 1 unit, kind of construction activity. So a lot of good content here, guys. You just got to play with it. You just got to poke around and browse around, bookmark stuff, and just visit it, right? Guys, make yourselves smarter. Make yourselves smarter around this stuff. And with that, let me go back to Q&A here. Andrew, what would you need to see to say prices are dropping 1 month year over year? Yeah, I like to say 1 month is random, 2 months are coincidental, but 3 months are starting to feel like a pattern. So, I think once you see 3 or 4, consecutive months of year over year price declines, maybe that's starting to become a pattern. But I still think you got to look at Is it because there's more condos selling? Is it because there's fewer million plus homes selling? So on and so forth. But again, in a market with 1.9 months of supply, we're not really forecasting any price declines in the near term. I almost want to say medium term, but near term is what, less than 6 months. Medium is maybe, or midterm is maybe more like 6 to 12. So let's watch it. Let's keep watching it. I think it'll be hard to see price declines, rest of this year and maybe even early next, probably. But let's watch it. Good question. Do we have one more thing in chat? Let's see. New construction. Aaron Dickinson was on. Oh my God, he's one of the original founders for the 10K research crew. Wow, I didn't know he was on. Matt Spector, new construction, depressed labor shortages and supply chain. Matt absolutely nailed it. We like to cite the 5 L's. What's holding back new construction? Lots, labor, lending, lumber, and laws, right? Lots, labor, lending, lumber, and laws. Where do I find this list of websites? You will see it in the slide deck that is emailed to you after, Aaron. Thank you to Team Holmers. Very much appreciate you guys coming. Thank you. Thank you. And with that, a couple minutes over, thank you for hanging out with us. I will wrap up and say, please join us next month. Honored to have you today, and I will flip it back to Jackson.
Well, thank you, David. And just a quick reminder for everybody who's still here, December's monthly housing market update is on December 15th, still Thursday, still 2 p.m. December 15th, you will all be getting the link to that to register in an email next week that will accompany the YouTube recording of this webinar and the slides from today. Thank you all, and we'll see you next time.
Thank you, guys.